Feroze Azeez of Anand Rathi Private Wealth. Gentlemen, thank you so much. First of all, Feroze and Mohit, let me start by wishing both of you season's greetings. And let me start with a, vote of gratitude. You've been our, guiding lights through this year, the last many, many years. So on behalf of all the viewers, first of all, a big thank you to you both.
Thank you so much. Thank you.
Thank you, Ravi. Such a pleasure and honor.
And I'm so happy that you have not yet taken off on your New Year holiday. And that you're here to give us some more wealth ideas.
Just in time.
Just in time, right? So that's the thing. Gentlemen, as you heard the introduction as well, I really thought that as I reflected back, yes, we may not have had the best returns, but I think we've got some invaluable investing and wealth management lessons this year. Whether it is diversification, whether it's patience, keeping the faith, so much. What comes to mind when you just reflect back at the year that's closing down? Feroze, what about you? I mean, what comes to mind as you go back to client conversations, interactions, and everything that 2025 threw up?
So Ravi, firstly, I'm gracious as well because I'm in the business of managing money for HNI. That's a few, right? Reaching out the masses and trying to give back to the Indian Awam, as the population you call, is the only ways to do it through electronic medium like a popular one like yourselves. So I'm very grateful, point one. And of course, the season's greetings, my season's greeting as well. I personally think there are about 4 or 5 things which have really gone down as a learning for me. I can take you through them during the show, but I think the first one I'll start with is courage pays off. Courage pays off, and I don't believe that equity has not delivered. Why? Because gold, there is only one price. At best, you will say 22 carat, 24 carat. Silver has one price, right? Debt has largely very narrow 7-8% kind of a return. Real estate is a divergent asset class. Equity is the most divergent asset class. I have a client portfolio which has done 18% last year. There's a client portfolio which has done 5% last year.
Okay.
Both operate in the same India. What distinguished? They have the same goddamn advisor, right? Or a distributor. But the difference in performance is because of courage, not because of my company's great advice or something. Right? One guy, in equity markets gave you 3 opportunities this year.
To buy.
And
one was when the Trump tariff tantrum hit us, right?
Before that also, during the budget and post that, on 8th or 9th of March, we saw 22,000 again. I went on a couple of channels and said, if I have 1 more years of bonuses coming, I would leverage and advance my payments. Because if I get 10%, 12% correction, almost 15% correction from peak, now I wanted Nifty at 0. What am I waiting for, right? So I think exhibiting courage rationally, mathematically, pays off. And I'm not buying some Sartoria stock. I'm buying mutual fund. Now their courage complemented with a low risk instrument in equity works very well. So first learning is don't go by the headline number. You can still make money in equity because equity implies 6,000 stocks, 900 mutual funds.
Let's pull up some of the graphics which will illustrate the points. So the first lesson that we've learned is that you've got to be courageous. You've got to buy when the market is falling. You've got to keep those SIPs going. That's lesson number 1. Lesson number 2, chasing past returns doesn't always work. And let's pull up the small cap funds. We'll just get the table up. So there's a DSP small cap fund. There's a Bandhan small cap fund. These are some funds that, Mohit just picked up simply to illustrate the point that if you're going to look at short-term returns, rear view last 1 year, then obviously these funds are, down between 1% to some of them. The HSBC small cap is down almost 12%. But then if you're going to stay the course, 3 years, 5 years, that is when the returns start looking much, much better. So then patience and not simply chasing past returns for a quick buck. That seems to be the very, very clear lesson 2. But in this, let's just take that active-passive debate a little forward. And with years of, having conversations with Feroze, I know that he's still very much a big believer in active management. He's not one for passives. But Feroze, Mohit does raise a very valid point, right? Because if the market is continuing to be range-bound and your own data threw up the kind of divergences in one index, one stock is up 50%, even on the Nifty. One stock is down 50%. Tata Motors is down 50%. Shriram Finance is up 60%. So the divergence in the index is also pretty stark. At the same time, picking the right winners is getting more and more difficult because the overall market is not giving you that momentum tailwind. So then where do you stand on the active-passive debate, the right mix now?
I've done my mistakes. I came to that conclusion that active ka khatam ho gaya time. And I'll tell you how I got a rap on my knuckles 3 times in my career. Okay, and so many of my clients. I'll come to that. See, firstly, on the courage bit, see, if there was just a 7th April dip, I won't say courage helped. Market languished out of the last 12 months at 22, 23,000 for 7-8 months out of those. If it just went to 21,700, it stayed there for 1 hour and then it closed at 22,300 on the Liberation Day as called by Mr. Trump. That people didn't buy at 21,700, I guess, I know, right? But if you give you 4 months and अभी भी आप हिम्मत जुटा नहीं पा रहे हो, तो आंकड़े देखने का मौका मिला. You got the time to see. Surabhi, at least 12 times, 16 times, right? Then you bring in some degree of mathematics. Second, and when do you get the courage also, I want to say. How do you get courage? Now, my clients are actually courageous. Why? In COVID year, Anand Rathi was one of the few distributors which purchased equity, whereas 1.5 lakh crores was sold from equity. It's because I tell the client markets will fall 15% every year. Before taking the check, if I said 2 lakh Sensex, if there's 5% fall, he'll panic. If I say every year it falls 14.73, that is the fall is there. Now, if you still have the courage, cut the check, otherwise keep the money in an FT. Then it's difficult to get the money, but when the money comes, it stays. How do you get courage also, I'm telling you. Look at the data. Now coming to passive and active debate. Okay, passive, I wrote off active practically. If you saw any of the shows in 2019, my model portfolio had underperformed Nifty by 9% in 2018.
And it was largely based on active funds.
It was all active funds. So the kind of hammering I got from my clients, I itself said, yaar, ye active chhod do, agar naukari rakhni hai. Right? This is the kind of mentality. And then I was almost gearing towards that and saying that passive is the way to go. 2020 came. I made alpha of 12%. Then came 2021, alpha of 8%. 2022, negative alpha of 4%. 2023, FY24, okay, large part of FI calendar year 23 because I see FIs, 14% again beating Nifty. So this has happened several times that you almost say that this year says that actives are over. There are 4-5 years. Just go look at the data. Worst active years, worst time where out of the 967 total funds, 665 active funds, any year where there were minimum beating, the next year could have been the year back for active. And then when I backward calculated what is making this happen, in years where FI outflows are there, becomes difficult for active to beat it. Right? That's one thing which seems like a hypothesis worth testing. I'm still testing.
So right now, what are you saying between active and passive?
I'm saying active will be very, very good. 6 months later, 1 year later, my model portfolio goes with only one objective. I want to beat Nifty after my commission of 1%, 4% per annum. I've done that for 11.5 years in 82 decisions. I think last year was not so good. This calendar year was not so good. But I think in the next 1-2 years, you will see alphas over Nifty superseding. And how that happens is FI coming back.
Gold and silver. I never thought when the year started that it will be the biggest point of debate when it came to personal finance, right? It's defied gravity. Some will say it's defied logic. It started with central banks buying more gold, and at that point it made sense. Underlying strong demand from a very strong buyer. But then I guess it just has moved on to becoming the biggest FOMO trade of all time. I know Feroze has never been a big voter in favor of gold. He still likes equities. So I'll come to that. But very quickly, now you tell us, Feroze, why I think despite this big gold rush, you're still keeping the faith more in equities. And give us the counter view. I think that you've never been too much in favor of gold, but will some allocation, is that required?
See, I don't like some. I do either decisive decisions or don't. Because if you have debt in your portfolio, gold is 100 times better than debt. I've said this numerous times. My clients, if I manage 90 odd thousand crores of assets, only 2-3,000 crores is in debt because that's for short-term money to be paid by my 12,000 client families. If I had 30,000 debt, be rest assured I would have had 15,000 of gold. Because gold can hands down beat debt. That's what data says. Rolling return of gold, 10-year rolling return, 1-year rolling return, I have all that data. The probability that gold beats 12% on a 10-year basis, rolling, not today, not 10 years of the exact past, rolling 10 years, is only 13.73%. If there is only 13.73% of rolling return of 10 years of beating 12%, do I have to say that equity will beat in the long run? It will. I put the same litmus test on equity, which is Nifty. Nifty, that is 57.81%. If one has 57, 56, 58% probability, the other has 13 for a long-term investing, how do I go against math being the CFO of the client. Second, now comes, should there be gold? Can gold be a hedge? Now, I tested that hypothesis.
Okay.
We listed down in the last 20 years, how many months has Nifty been negative? There are 103 months where Nifty has been negative. In those 103 months, how many of the months was gold positive?
Okay.
That is 66. So 2/3 of the time, when Nifty was down in the dumps, gold was positive. So does it have a hedging ability? Which 10 years back, if you asked me, I was shooing away gold as a hedging capability. But after looking at this data, I correct myself that it has the ability to hedge.
So maybe to that extent, it could have a place in the portfolio. So, okay.
But stagger the money. If you wish to move your debt to gold, stagger the money.
Stagger it
because there is 216 lakh tons mined. 54 to 69,000 tons to be still mined, identified gold reserves. 8,000 of it, 4% of it is owned by US.
Okay.
You can be very easily into a trap by these central governments of pump and dump.
Okay, so now as we are wrapping up the first part of this special year-end conversation, let's quickly recap. Simple bullets, lessons that the market, not just the Indian market, equities, gold, fixed income, lessons in wealth management that the market has taught us this year. Feroze, quickly.
What this taught us is our dependency of equity has come down dramatically. 5 worst years of FII flow. One of them, the worst year was this year. 1,55,692 crores is gone. Nifty's maximum drawdown is 8.71. Nifty from peak to trough fell 8.71. Last time was calendar year 22, where 1,21,000 went out.
Domestic money supporting the market.
Supporting the market. So point I'm trying to make is if you look at this data, it very clearly says we are more dependent on risk from domestic guys. On return, we are dependent on FII.
Okay, all right. Viewers, so we have to call it a wrap on this part of the conversation, but this is only part 1. Remember, same time, same place next week. The even more exciting part of this year-ender conversation comes up because that's when these two gentlemen will be giving us wealth ideas, specific funds to watch, fund managers to watch in 2026, and where you should be investing your money. So make sure you tune in, same time, same place next week.